ASML, they just had their earnings report. And just a month or two ago, we had an update on wafer fab equipment, which is right in the center of our industry flow. It's a critical choke point. We did an update on the wafer fab equipment outlook based on what we were seeing from reports from some of these companies, as well as what semi.org reported. So let's take a look at what ASML just reported and kind of break that down a little bit more deeply about what we can expect from wafer fab equipment companies.
So here's the high level data point that is always the most important thing when you pull open a quarterly earnings report. Is there any change in the guidance? And especially at the start of the year, you tend to have bigger changes. Hopefully, usually in a bull market, most of those changes should be to the upside to expectations. And sure enough, ASML said at the low end of their former guidance, they raised that by 2 billion euro. And at the high end of the guidance, raised it by 1 billion for expected revenue. So new range, 36 to 40 billion euro revenue expected for 2026. That implies about 16%, 17% growth year over year. 2025 was a great year, a return to robust growth for ASML during this cycle. So they're building on that. That's a good upgrade. You can see that here in our revenue chart from over on the research dashboard. On the left, there's revenue last year at just shy of 33 billion euro. And they had record GAAP net income, or IFRS net income, on the chart there on the right of 10 billion euro.
So as you said, probably slated for another record year in 2026. But what does that mean for all of the other wafer fab equipment companies? Because we're obviously seeing a lot of spending from companies like Taiwan Semiconductor Manufacturing, some of the memory makers, when there's all this talk of bottlenecks in memory. Here is a look at the semi.org report. And this was from back at the beginning of the year.
Yeah, they put this one out just before the end of 2025. So this was like mid-December. And this still stands. They haven't updated this particular one. Their guidance for low teens growth in total wafer fab equipment still stands. So there's going to be another record year this year. Also, big increases in test equipment and advanced packaging. That's where the more dramatic growth is coming in, is those two. Test equipment, 12%, moderating from 40-50% growth rate from last year in the rebound for test equipment. So where does ASML fit in that? This is where semi.org has updated their guidance a little bit. This is specifically for the 300 millimeter fab, the 12-inch wafer equipment part of the market. They updated this to be 133 billion. Obviously, 300 millimeters, this is where most of ASML's equipment gets sold. The highest value equipment is for the 12-inch wafer fabs. That growth rate is going to be a bit higher, 18% this year. So the lower end stuff is expected to be more sluggish for 2026, driven by, like Casey just said, TSMC, the memory, IDMs, and so on. ASML specifically is going to be basically at industry perform or slightly worse. This guidance that semi.org gave implies about a 2 basis point underperformance for ASML compared to the 300 millimeter wafer fab equipment market overall. So I think that's an important data point to keep in mind with a company like ASML. Like we've been talking about, a lot of the market shifting to advanced packaging. ASML doesn't really participate in that so much until more recently when they had the new lithography machine, the I-line machine that they updated for the times to address advanced packaging. The puck has definitely moved in a new direction. And so we need to acknowledge that, I think, first and foremost.
Does that mean we're headed for a full-on bear market?
That's the next interesting thing besides ASML's earnings and the semi.org chart that accompanied this update a couple weeks ago. Remember back in December when we were talking about the general cadence of technology releases, especially for networking chips, which have caught up, you could say, in some ways with the GPU performance boom that NVIDIA set off a few years ago now. We were specifically talking about Marvell Technology and their acquisition of Celestial AI. We said that there was sort of a gap there in the portfolio rollout. And then we saw this again with Credo and Astera Labs, which we had updates on yesterday for the research app. We said there's a possibility that we would have a mid-cycle slowdown or even perhaps a mid-cycle downturn for the semiconductor industry. This chart you see here almost softly implies that is more than a remote possibility. It says 3% is the expected growth rate for the fab equipment in 2028. Basically, what that means is by 2028, the leading manufacturers will have caught up with capacity that their customers need. And so they're going to pull back a bit on spending on new equipment. But when we're talking about the future, we're always talking about probabilities, not what's definitely going to happen, but what's the probability. And when you see a growth rate start to tail off in 2027, next year, and then go down to basically just flat for 2028, what you're seeing is an increased probability of a downturn for the industry. Nothing severe, just a normal cycle. Remember, we're talking about manufacturing and hardware. The cycles tend to be fast.
Let's do a reverse DCF then on ASML specifically. So we're using earnings per share on this reverse DCF, which is $24.72 over the next 3 years. And that's based on the guidance that we have and from semi.org and these wafer fab equipment companies. Terminal rate of 6%, discount rate of 10% gets us to an expected growth rate of 43%. This is one scenario that gets us to the current stock price around 1,500 per share. So it's a really high bar, 43% growth rate.
It is. And we tighten this up. Lots of questions we continue to get on how to build a DCF or a reverse DCF. And it depends on the business. You really have to just be intimately acquainted with the industry and the business. And the reason we tighten this up on this particular scenario is because of the last chart we just showed you from semi.org. We already said back in December, we thought it was a real possibility that by middle to end of next year, we could be looking at a cyclical slowdown. And sure enough, we're not the only ones that think that. It's implied in that growth outlook chart. And 43% just seems awfully high for an earnings per share growth rate. So we're not selling or other equipment stocks yet, but do bear in mind, this is not the most cyclical part of the semiconductor industry. Individual component makers and designers like the memory and some of the networking companies. There's an unpopular thing no one wants to hear, but those tend to be the most cyclical of the cyclical part of the industry. The equipment manufacturers are also cyclical. Even though they tend to remain profitable, even in a downturn, they are still cyclical. We're not calling it yet, but we're calling out the fact that the market has gone hardware crazy. Everybody thinks software is completely dead, which is ludicrous because it's more of an end product, finished product than hardware is. So a lot of investors are going to learn, once again, the hard way, the proper way to invest. And a lot of the uninitiated in cyclical industries like semiconductors are going to learn some hard lessons. That is a given.